So, what's up guys? Today I want to talk about, it is not really a new strategy, it is a well-known strategy, but I think a lot of people don't actually kind of get it right, or it's hard for them. So I want to explain my strategy behind it. It's simple strategy, it's the bearish divergence, which means you've probably heard it before. Now I'm just gonna show you my approach on some examples. So here we go. So in front of me is Dogecoin, whatever. Doesn't really matter. Now you always want to look for an uptrend or kind of a bullish market, which is here. You can see the market rallied from the beginning of January 2021 until May. Now obviously I'm not that big of a fan when it comes to trading cryptocurrencies, since the volatility is somehow completely different than in other markets. But for this example, this one works pretty well. So this is why I'm gonna use it. Now to determine the trend, it's actually really simple. You can get some indicators, some EMAs, crossovers, doesn't really matter. Here we are clearly above the 20 EMA. You can even use the 51. I mean, basically, as long as we are above the 200 EMA, it is considered to be an uptrend. But here the momentum is pretty bullish since we are above the 20-day EMA. Now, after determining the trend, we want to look for the divergence, which is actually pretty simple. Now we can see here that the market formed a higher high, while on the other side we have formed a lower high, which indicates that here somewhere at this area, even here, we will go lower. Now this is not a magical strategy or something that is a secret. It's something that most traders know. The only difference is people don't know when to enter or when to exit, which is the difficult part, because sometimes if we have this divergence, I mean, we could go to new lows, but at the same time we could just drop, like, maybe, depending on the market, but maybe 1 or 2% and then go higher. So you want to focus more on the entry and the exit rather than on the strategy itself. But so anyway, we are looking for this divergence on the RSI. Now if we add the MACD, you can see here the blue line and the orange line. So basically what you want to focus on is you want to look here for a crossover between the blue and the orange line, which often you can determine slightly before it will happen. You can see here, if we zoom in, you can see that the space between the two lines is getting smaller and smaller, which means once we see a cross here, if we go down to the 4-hour chart, back, so now we determine this area to be a bearish one, somewhere around here it will happen. Now you skip, you go to a smaller time frame, just one time frame smaller, and you go to the marked area. Now if we take a look at the marked area as well, we can here see a divergence as well in the smaller time frame, which is something that happens most of the times. Here is one as well. Actually, sometimes the divergence even happens on the MACD, which is even a better confirmation, which means if you now see the time frame, the divergence on the smaller time frame on both the RSI and the MACD, and like I said, we skipped one time frame, we went to a small time frame. You want to look here for the cross between the blue and the orange line, which would be in this case pretty much this candle here, and here it would be, well, let me zoom in quickly. How do I get rid of this one? Something like this. Okay, so the cross would be around one of those two candlesticks here. Depends. I mean, if you go to small time frames, you could maybe even determine it even better. But the thing is, you might maybe see something completely different and suddenly see a bullish sign and then completely get out of the trade. So basically, it's one of those two candlesticks here. It doesn't really matter at this point, because what I actually want to focus on is, let's say you get in here, let's say you take the middle of the candlestick here. Doesn't actually really matter. You could get in on top. Well, it's actually would be difficult to get on top. I mean, if you actually look at the cross, it actually happened at this candlestick. So if you were able to get in here, even better. So it doesn't matter what candlestick you take, one of these two candlesticks here, and let's say we assume we get in somewhere in the middle of one of those two candlesticks. Now the close would be above the candlestick, actually slightly above. So we could even make it smaller. It doesn't really matter. Now when do you want to exit? Now we wait for the MACD to go as low as it can, and when we see the next crossover, this is, especially since we are in a bullish trend, the chances are that we might go higher from here and go to completely new heights, which means we can exit a little bit before the crossover happens, or if somehow we determine that we are at a specific EMA that kind of looks like it could turn around, we could exit there as well. I mean, taking the lowest point here would be a magical feat, which means it's almost impossible to always take the lowest part here and to enter the highest part. But basically what you want to focus on, so if you take this point here, this candlestick as an exit, here we actually would still have, depending on your entry and your stop loss, a risk reward of 3.25 or whatever. Maybe you could turn it into a 4 point, doesn't really matter at this point. Your goal as a beginner is 2.1 to 2 risk reward ratio, which means this is what you want to focus on. So if you enter here, you want to at least take 2 pips for one, which would only take you well, here it will be like for about 12 hours. And this trade, if you entered here, would take you up to 2 days. If you exited here, well, maybe a little bit longer, doesn't matter. So in here you can see the same thing. If you, let me just quickly get rid of this. So the candlestick that we are focusing on is the red one here. So again, if you short the position here and close it slightly above the candlestick itself, and then go for a 1 to 2 risk reward ratio, again this trade would have taken you for a 12, about 16 hours, probably not even 16 hours. If you waited again for the next crossover, which happened here somewhere around here, which means your risk reward would have been 3.4, almost 3.5, and it would have taken you 3 days, which means this is a very simple strategy. You don't even have to take for months, hours, or whatever. At the same time, you don't have to scalp and be constantly in front of the screen. Now, the only thing is that I would recommend you is to do it on bigger time frames and maybe not on smaller time frames when you are trying to scalp. It's not that it's not working, but it's a little bit different. So for now, focus on simple strategy, maybe on a daily 4-hour chart, and a simple 1 to 2 risk reward ratio.